ARM released their latest quarterly earnings a couple of days ago. When they released it, the day after, the stock went down a little bit, but right now it recovered over $108, meaning it has a market cap of over $111 billion, a forward PE of 69.1 times, a bit higher than its 1 year mean or so. If you look at the other metrics, EV to EBITDA, price to sales in the next 12 months, yes, it is quite elevated, price to free cash flow as well, but price earnings to growth has come down quite significantly, now at 1.97. Of course, much more interesting right now compared to the, 30, 40 number it was not so long ago. Currently, if you look at the average analyst price target, it sits at $112, representing around 3% upside from the price we're at today. If we look at the stock's performance year to date, is up 44.8%, had quite a performance, of course, when it became a publicly traded company. Just so you know, SoftBank is still the biggest holder of this stock, which means they can still sell off quite a large chunk of it. Depends how they do it. They've been selling chunks here and there, so there is minimal impact on the stock on the public markets. Now, currently, if we look at the analyst estimates for fiscal year 25, 26, 27, on average, you're over 20% growth year over year. Now, if we look at fiscal year 2027, the stock is basically trading at 44 times fiscal year 2027 EPS. Of course, if it can continue to grow 20% year over year, I mean, that could be quite interesting. Of course, we know growing top and bottom line 20% year over year consistently is not as easy as it sounds. But seeing how dominant ARM is, seeing how, in my opinion, we're still early days when it comes to AI, compute, inference, etc., ARM being the company that it is, I think it could have a shot at continue to grow at those growth rates. Now, I am a bit skeptical in the short term because, as we will see in the numbers, you would have expected growth to be much better than it currently is. But we'll dive a bit deeper in that in just a second. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's first start here with ARM v9. So the technology now contributes around 20% of royalty revenue, up from around 15% last quarter. Chips based on ARM v9 can command a substantially higher royalty per chip than previous generation architectures, which of course is great since ARM, the majority of its revenue comes from royalties. A couple of comments here from their press release. So growth will be driven by ARM's unique ecosystem of software and design partners. ARM has the world's largest compute ecosystem with more than 18 million software developers, and we continue to increase investment across all market segments to accelerate software development on ARM. ARM and Intel Foundry Services announced a multi-generation collaboration to enable chip designers to develop advanced ARM-based system-on-chips to be manufactured at Intel Foundry, initially for mobile and data centers and potentially for IoT and automotive applications. This builds on the announcement last quarter relating to Intel Foundry, TSMC, and Samsung participating in the ARM Total Design ecosystem. As cloud service providers continue to shift to ARM-based chips, many of the largest enterprise computing applications are following the Oracle databases, SAP HANA, Microsoft Teams, Google's YouTube ad platform, among others, now running on ARM with better price performance and power efficiency than legacy architectures. Which moves me into the Q4 highlights. So revenue increased 47% year over year to $928 million. License and other revenues are up 60% year over year. Royalty revenue up 37% year over year. Non-GAAP operating income, $391 million with a 42.1% non-GAAP operating margin. Trailing 12 months free cash flow is up 50% year over year to $907 million. Of course, a highly profitable business, high gross margins of over 90%. Then if we look at royalty revenue is up 37% year over year, as we've just seen, but only up 9% quarter over quarter. This was basically my critical points, let's say, the last time we've covered this. I mean, we know that there is a lot of demand, we know there's a lot of momentum, so why aren't we seeing this quarter over quarter, right? We've seen this with the like of Nvidia. They talk about huge demand, AI, compute, but we're seeing that. We've seen those huge increases quarter after quarter. With ARM, we're not quite seeing those positive effects just yet. But I don't want to say that having such a structure in the business, right, the royalty revenue, it is a huge benefit for this company. As you can see here, it's still collecting royalties on products developed in the early 1990s. Then looking at the markets that they are playing in, mobile applications, other mobile consumer electronics, cloud compute, networking equipment, automotive, IoT, etc., etc. Those markets, the value of those markets have been increasing, and the market share has been increasing as well for ARM, which of course is a recipe for success, growth, and for them, since they are a highly profitable business, huge earnings. Moving on to remaining performance obligations, or RPO. So RPO is up 45% year over year and slightly up sequentially, driven by multi-high value long-term agreements. Again, this is great, but if there is truly huge momentum, huge demand, etc., etc., I would personally have expected the quarter over quarter performance to be a bit better than what we're currently seeing. As for non-GAAP gross and operating profit, like I said, highly profitable business. Gross profit with a gross profit margin of 97.2% for Q4. Operating profit still above 40% at 42.1%. Then looking at guidance, and this was basically the reason why the stock fell a little bit after the company reported their quarterly earnings. So revenue for Q1 to come between $875 to $925 million, but for fiscal year 2025, it will come between $3.8 and $4.1 billion. So revenue outlook was lower due to softer royalty. The expectations were 4.1, and now that $4.1 billion is basically the top end of their guidance. Maybe they will beat it, maybe they will raise it in the coming quarters, remains to be seen. But overall, going back to this slide right here, when it comes to royalty, not the licensing part, just the royalty part, if this momentum continues, right, they grow market share in markets where the value grows up and up and up as well, then it should be reflected in the financials. It should be reflected quarter over quarter in huge increases. Right now, we're not quite seeing it just yet. Because if we go back to guidance, right, this quarter we had Q4 revenue of $928 million. For Q1, they're expecting revenue actually less than Q4. Of course, Q4, strong quarter for them, but still, if you are having all of those momentum, if you keep repeating that we're a strong position, we're growing quite fast, there is lots of demand, etc., etc., I would still have expected quarter over quarter performances to be much better, especially when you are highly valued. But then again, they're not the reason why the stock is highly valued, the stock market is. And so if we look at the stock right now, in mid-April, we did get a small correction when the stock went under $90. I thought we would go a little bit lower towards that previous resistance at around $80 or so. We didn't go as low. I think it dropped to $85. Then it made its way back up to the 50 and the 20-day moving average. It seems like we have now been rejected a tiny bit at the 50-day moving average. Remains to be seen what happens next week. Of course, we still have the big one, Nvidia's earnings report. I think that will probably again make or break the market, especially when it comes to semiconductor chips. And so overall, while we have seen that price to earnings, EV to EBITDA, price to sales in the next 12 months are now a bit cheaper than before, right? Before the last couple of videos that we made on ARM, the valuation was way higher. But now again, that we've got more information, another quarter in, more numbers with regards to guidance, that has come down a little bit, and price earnings to growth has come down quite substantially. So yes, it makes maybe right now a little bit more sense. But still, in my opinion, it is quite expensive, despite it being an extremely dominant company in its industry. But of course, I'll be the first to admit that some stocks will never trade at a cheap valuation on the stock market. We've talked about plenty of companies that always get a premium from the stock market, and you would just have to live with that. Even if the stock corrects 20-30% or so, these types of stocks where the market will continuously give it a higher premium will always look expensive. But the focus should be on the business performance. Can the business continue to grow at a high rate? Can it continue to grow top and bottom line over those 20+%? For now, I think it can. You just hope that this stock does not go up too much, and so the business will always have to play catch up. It's much better to have a business grow fast and then the stock eventually plays catch up, because that allows you, a long-term investor, to grow your position. Because right now, I believe most of us are just trying to chase this thing and look for better opportunities. Maybe that's just me, but of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.